Lending policy is an interesting one because, we can do all the numbers for a client. We can get them a pre-approval based on today's scenario, but also based on today's policy, bank policies as well. Now, the true test is obviously when it comes time to actually, as it gets closer to settlement, that's when we get the formal approval through, because we really have to wait until the property's pretty much done and finished so we get the valuation done. Now, that's when the bank will do their final assessment.
100%, and that probably part of it is, like we mentioned before, interest rate change, right? Like if you purchased an off-the-plan property in 22, interest rates were 2%, and then you're settling in 24, 25, interest rates are 5 to 6%. Like that would have eaten a lot of your servicing capacity, and all of a sudden you can't settle on that property anymore. So welcome to another podcast of the Brokers Lounge. As usual, you've got Eddie and Carlo, and this time we're going to be discussing buying off the plan, things to be aware of, what to know, what to be, taking into consideration, what is good for buying off the plan, and everything in between. But as usual, before we start, Carlo, how you doing, mate?
I'm doing very well.
You're doing well?
Thank you for asking.
Yes. That's great to hear.
Yes. I feel like I'm on the home straight before a couple of weeks leave coming up, which would be nice. So
Yeah.
But
We're not all as fortunate, but
you've had your time. Come on.
have I? When was the last time I took off?
Not that long ago.
It was in August.
Actually, it was a long time ago already.
July.
That's scary because I actually felt like yesterday that you went away.
I know.
I'm sure it doesn't feel like that for you. Nah, all good though. All good.
We've got the wedding coming up, so well,
yes.
I hope you.
We'll have anything to talk about after that. You know that. So
hopefully not.
I'm sure I'll find something else.
You'll find something.
Might give me a bit of time to, ramp up my hobbies.
Take your time, mate.
Golf. Golf.
Yeah,
more
golf
into
in
golf.
winter.
Yes. Yeah, probably not. Anyway.
All right, let's jump to it. So, buying off the plan, what does that mean? It's basically buying a property that hasn't been built yet, and you're pretty much buying based off the drawings and the plans that the builder or developer has presented. So you're basically buying a non-existing property yet. Hopefully it will exist, and that's where risk sometimes comes up, which we'll get to in a minute. So the key issue is usually the time from signing the contract that you are ready to purchase to the time the property's ready to settle. And there are many factors that we will discuss that could potentially risk the purchase or could leave you in a worse position. And sometimes it could leave you in a better position depending on your luck, I guess. So what we'll cover is the valuation risks. We'll cover the lending changes that might happen during that period, the interest rate impacts if there has been a fluctuation in the market, any delays with the construction process, the developer's risk, and if they go bust or something happens to the developer during the process, and what can you do to protect yourself, or at least just be mindful of these things. So,
I think maybe just to quickly kick it off, we'll probably just quickly touch on why buyers actually choose off the plan.
Yep.
And I think it was many years ago, it was actually probably a little bit more popular for various reasons. But I guess one of the main appeals is that lower upfront cost because they typically don't have to outlay like a full 10% or even 20%. They sometimes get away with, $5,000, put their money down and sign the contracts and off they go. So there is typically a much lower deposit structure that's in place. The other thing would be is that, like you said, settlement is typically going to be 12, 18, 3 years away, whatever it might be. So how people see that is, well, I know I think I can probably afford it, but at least I've got a bit more time to save up for the deposit. At least I'm locking something in now. It gives me time to ramp up my income and get that deposit in place as well. So, and I guess that is one of the perceived benefits that you're locking in on today's purchase price. There's obviously upside to that. There's obviously downsides to that as well, because we just don't know what it's going to be like when it is actually completed. One of the other perceived benefits is it's brand new. And everyone loves a property that's brand new because you're typically designing it to a certain degree to suit your own taste. You're not typically buying a property that's 50 years old that might have issues with it and going to cost you more money than it's actually worth. So having something nice and brand new, feels good, looks good, and it typically will come with a builder's warranty as well. So if anything does get or have any issues with it, they can fix it for you as well. Quite often comes with government incentives as well, especially for first home buyers. Being able to build something gives them access to the first home buyers, the first home owners grant. And as I mentioned earlier on, obviously time to save additional funds before settlement actually happens. So, which is, I think, a big thing because a lot of people do get deterred or turned off of buying a property because they just can't come up with a deposit. Someone who's renting, this is a good way to get in the market and build that deposit as you get closer to settlement. So, like I said, it's often attractive for first-home buyers, but also first-time investors as well. So, good chance for them to get into the market itself. But essentially, and we'll talk about the risk now, is what happens when your financial situation at settlement is when it really matters, or as we get close to that, anyways. Because we can do all the numbers now, but it may be 1, 2, 3 years down the track when it really matters. So maybe you can run through one of the risks.
Yeah, one of the risks, like we mentioned before, is the valuation risk. And that's usually the case when you originally signed the contract for, let's say, $700,000. You're buying a land this happens with lands where they haven't titled yet, or with like apartments. You buy the property at $700,000, and then there's a delivery time of 2 years. During that 2 years, the market fluctuates and prices drop. So what you signed on based on $700,000 purchase price, by the time you are ready to settle, a valuation needs to be done. And if that valuation comes in lower, let's say for $650,000, then the bank will assume the value is $650,000 because the bank will use the lower of the contract of sale or the valuation, whichever is lower. So there's a gap of $50,000 between what you purchased the property for and what the actual value or the bank thinks the value is. So that can cause issues because you either need to try and find other banks with better valuations, and that could cause some stress, and hopefully you can find a better valuation to bridge the gap. But if you can't, and all valuations come in at $650,000 or lower than the original contract of sale, then you have to either come up with the difference of $50,000, or you need to consider other lending policies, or just go like 95% and take on lender's mortgage insurance, or you need to really find a way to get out of the contract, which is usually very hard to do, and the issue would have happened. So that's one of the biggest risks, and that's something I've seen in the past. So just something to be mindful about, especially where the area is. So if there's a lot of developments happening, if there's an oversupply, also obviously you can't really measure all the risks, like if the market conditions change, right? Like, how would you know if the market conditions going to change, or if the interest rate's going to go up and then all of a sudden there's a huge drop in demand? So, but it's something that happens all the time. But on the flip side, I've seen instances, and that's really, I've seen in probably like 5+ years behind. I haven't seen lately, where people used to purchase a land for like $200,000 and then it's valued at $400,000 come time.
Some people used to actually flip the land before it even comes to settle.
I've seen a lot of people do that, and they made a lot of money. But I don't think it's happening anymore because developers and builders are taking that for themselves in a way where there isn't much room to flip anymore. So,
Inner city apartments was always one of the bigger issues, wasn't it? When they were building, I remember here in Melbourne when they were building so many around that Docklands area, and they had a lot of overseas investors purchasing these apartments off the plan. 3 years later, market turns, and then they've got this huge influx of completed apartments on the market that can't be rented out. There's no demand for them. People can't sell them anymore. And all of a sudden they go to do valuations on it, and it's just absolutely tanked.
Absolutely,
and I saw quite a few instances where borrowers had to come up with thousands of dollars of extra cash because the valuations just came in so much lower. So
100%. Yeah. So that's the valuation risk.
Yeah.
What about policy?
Lending policy is an interesting one because, we can do all the numbers for a client. We can get them a pre-approval based on today's scenario, but also based on today's policies, bank policies as well. Now, the true test is obviously when it comes time to actually, as it gets closer to settlement, that's when we get the formal approval through, because we really have to wait until the property's pretty much done and finished, so we get the valuation done. Now, that's when the bank will do their final assessment. And if their policies change with regards to location of the property, various different things to how they treat income, everything, it's that time where everything gets reassessed. Now, if policy moves that much, then once again, buyers can find themselves in a position where come up with more money, find another lender, which could mean a higher interest rate, whatever it might be. So you really need to make sure you've got sufficient buffers in place so that, if things do change negatively, that you're not going to be caught out from that side of things. So it's one of the hard things to do is you're buying a property today, and like I said, your property may not settle for another 2-3 years time, but we don't know what your circumstance is going to be like in 2 or 3 years time. You could have a completely different job.
You don't know what your circumstances are going to be.
Exactly, yeah. So, you've really got to be really cautious and do as much due diligence as you possibly can. But yeah, just keep that all in mind.
Yeah, 100%. And that probably part of it is, like we mentioned before, interest rate change. Like if you purchased an off the plan property in 22, interest rates were 2%. And then you're settling in 24, 25, interest rates are 5 to 6%.
Yeah.
Like that would have eaten a lot of your servicing capacity, and all of a sudden you can't settle on that property anymore. So yeah, that's the risk, right? You run by going off the plan, and that's why a lot of people try and avoid it, but it's out there, and yeah, you just got to be mindful of these things. Probably also delays, construction delays, like that is a big one. That happens pretty much all the time.
I think more often now than what it used to be. And it's, there are a lot of, we've seen so many building or construction companies go under as well, which means there's less builders in the market. We've seen builders go under whilst they're developing projects.
Yeah.
So that could potentially happen. You've got to be really mindful of that. And if there's less builders in the market, it's going to be harder to get them to complete jobs on time. So you could have builder delays. Supply chain issues was one that came up recently, where there was a shortage of timber.
Yeah.
Then people go, well, that's fine, we'll switch to steel. And what happened to that? They bumped up all the prices on steel. So we've got weather to contend with as well. You have a real bad wet season, and all of a sudden that project could be blown out by quite a few months. Planning delays, I think that's a big one, because I've seen so many developments just caught up in planning for months, if not years, and that can be a big issue. So, and essentially what it ends up doing is just it pushes back settlement for quite some time. And once again, you bring into consideration all the other risks we've just been talking about, your own personal finances, lending rules, etc. So. It really does highlight that probably borrowers or buyers have limited control once your contract's signed. You're not in the hands of God, but there's so many factors that are outside of your control. Like, you can't control really if there's any construction delays. That's not something you can go into the construction company and go, well, no, sorry, you've got to work overtime and get this completed on time. Just another risk to take into consideration.
Yeah, and that's why it's very important to be able to do a bit of due diligence before you engage with the developer, and just really research the developer, see what projects they've done in the past, just try and get as much information if they've completed similar projects, or are they like going next level and just overstretching themselves with the project you're buying into. Just see if the projects they've done before had any issues with building issues. We've seen a lot of buildings recently where they completed and then there's either cracks or there's the cladding issues. So it's things that you need to be mindful about. And that's something really important. Like if the builder's reputable and they've done the right thing in the past, and people who have purchased or dealt with them, they give good feedback. That could be like a really important point. Because if you don't do that, then like you said before, if the developer goes bust during the project, you are potentially looking at losing whatever funds you've put initially, and you just like all your plan is out of whack because you've got this project you're focusing on, you're saving, and then you need to go and try and find something else. It can cause delays as well, where you're meant to settle within 18 months or 24 months, and then you're sitting at 36 plus months, and there's still no time frame on when settlement is expected. And if you can avoid many like the issues or financial or development issues, then that's the way to go.
Yeah, and I guess if you're renting and say you're purchasing, this is your first home or first apartment, whatever it might be, those delays can cause issues as well, because you've got to re-sign another rental agreement if yours runs out. You probably don't want to be signing a longer term one. There's the unknown. Okay, if I sign another 12 months, what happens if it's ready in the next 6 months? Some landlords won't allow you to go month to month. So, and then all of a sudden the rental market can change as well. All of a sudden you're re-signing another rental agreement and rents have gone up massively. So
absolutely.
There's so many things that that can cause issues when it comes to those type of delays. So and I guess one of the other things is what your property is going to look like at completion as well. If there is any differences from what you signed, developers are very good at producing wonderful marketing material that make their apartments or properties, whatever they're developing, look really nice. But sometimes there are the finishing
quality
product. Exactly right. And those contracts, I don't know if anyone's seen those contracts, but pages are probably like this, like 300 pages, and they don't typically allow for too many variations. If it's going to be any variations, it's going to be very minor. Otherwise, you're going to be paying through the nose. Or they may not even allow variations. Like if you're buying an apartment in a big complex, they're not going to allow massive variations because it just upsets the whole structure of the building itself. So
100%.
It's just another thing to keep in mind. Probably not a huge one in the overall scheme of things.
It is actually, like, especially that guy on TikTok, the property inspector.
Oh yes.
I think that guy has probably created a massive awareness in the market with the builders and people, because you move into the property, it looks flashy, it looks nice, but then if you don't know what to look for, and then he goes in and then there's water under the bloody water areas, and then the I don't know, cladding, or then there's the gutters, or there's heaps of stuff that you don't know what to look for. And then, you've got someone professional, they come and the property all of a sudden is non-compliant, and the builder has done a shitty job, which is going to cause you issues in the years to come. So
and like you said earlier, the contracts are quite often difficult to get out of. Like once you've signed, it can be a financial risk, and or they'll hold you to it. So you just got to find a way. So really do your homework, isn't it?
Absolutely.
So how can buyers protect themselves, Eddie?
So few things. Obviously, awareness is, I guess, the first step of knowing what to look for and what to be aware about what could go wrong. So I think avoid borrowing at your maximum capacity. Always leave a buffer in case valuation comes in shorter, or in case anything changes, interest rates go up, policy changes, you've got a decent buffer to play with.
So when you're talking about buffers, it's not just a monetary amount in terms of your contribution towards the purchase, but it's also servicing as well.
So if you can borrow, let's say $1 million, try to work around 900,000. So this way, if anything changes, you still got a decent buffer, obviously assuming your income doesn't change. But then it's important to have as much savings as possible during that period where you sign the contract and waiting for settlement to happen. Just try to pump that savings account as much as possible. In the event where valuation comes in shorter, then you've got the cash to contribute and just get settlement done.
And if prices don't, if everything works out well, just buy yourself some really nice furniture.
Or just leave it in your savings. Right?
Buy the big 100-inch TV. Go big.
Yeah, 6 of them.
One for each room.
Not enough screens in our lives. Like we said before, research the developer or the builder. Just make sure they're reputable, there's no issues, and probably the most important one is speak to a broker, right? Just to understand your borrowing, go through the contract, see if there's any issues there, try and get some sort of pre-approval. Because look, this is a tricky one, because if you know settlement is 3 years away, really a pre-approval is irrelevant, right, to get it now, because it's going to be expired by the time you settle, and circumstances change, policy changes, all that sort of stuff. But where the value is, speaking to a broker, is understanding what your maximum capacity is, understanding what your buffer is, understanding what sort of savings you need to aim for, and just knowing exactly what is the maximum and the minimum you can go for in terms of valuation and purchase price. So it just gives you a good set of metrics to work with, and that provides clarity, which is very important in the purchase process. So always speak to a broker or any financial professional you can find. And that obviously allows you to understand the finance risks, and hopefully you don't have to go through it, but it's really important to know what could go wrong. Right?
Yeah, 100%. Yep.
I don't know if I missed anything, but...
No, I think you summed it up very well. So, and by no means do we want to cast a negative, impact on buying off the plan, because they can actually work quite well for people, and it can suit a lot of people. You just need to really understand the financial risks between signing of the contract and also the settlement date itself. Remember, the biggest risks are going to be around valuation shortfalls, lending policy changes. I know we're saying the same things over, but I just want to recap on this. Interest rate increases, which is quite probable nowadays, and construction delays. So, if you're considering buying off the plan, make sure you understand how the banks assess these deals before committing. So seek as much advice as you possibly can. That'd be the main takeaway, I think, for this. So
that's it.
All right, very good. Well, thank you very much for listening again to another podcast of the Brokers Lounge. We hope you took some value out of this particular episode. Continue to subscribe to our podcast, leave us some feedback, give us the 5-star rating. And until next time, we'll catch you later. Take care, everyone.
Thank you. Bye-bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.